Two things that I'm tracking. I always track the plumbing first, and then I see if it's affecting other things. So what I mean by the plumbing, those who follow me probably know what I'm talking about. The interest rate that is the basis of all other interest rates, that's the secured overnight financing rate, the rate at which banks charge each other to loan cash in exchange for treasuries overnight. That's it's heading higher and higher and high. It's drifting higher, even higher on some days than the Fed's upper limit on the Fed funds rate. The Fed funds rate is like a different thing. It's a very minor market. It doesn't even matter anymore. It's like the volume there is like $100 billion a day at most, whereas the secured overnight financing market is like over $3 trillion. So the largest volume has been 3.2 trillion. And it keeps going up, the volume, which means more and more banks need money overnight for whatever reasons it is. I mean, it's probably a lot of the bank's clients are engaged in some kind of basis trade on whatever treasuries, and it keeps getting bigger and bigger. They can't provide the dollars, then those trades have to close. The Fed is in a bind now. Because eventually this is going to lock up pretty soon. I thought it was going to lock up already because there's less than $3.2 trillion in bank reserves out there, but apparently you can go above that. I don't know how much farther you can go above it, but at this point, last time we already had locked up in 2019, and then from there came the expansion of the balance sheet, and then from there, a few months later, was the COVID printing round. And now you could see that as a separate phenomenon or a coincidence that they had an excuse to print like $4 or $5 trillion just a few months after the plumbing locked up. Or you could take a more conspiratorial angle and say it was planned, or they just had an excuse and they went with it. Whatever it is, I mean, they needed to print the money. Ever since then, from then until around now, there were no more repos provided by the Fed. You mean repos provided by the Fed is when banks don't have enough cash to lend to each other, so the Fed has to step in and say, you know what, we'll provide the missing cash. So that was the case from about maybe like 2014 to 2019, like after QE3 ended, and they started shrinking their balance sheet for the first time. So there were repos in those years until 2019, and they stopped. Then they started again after the apocalypse, and then they stopped during the COVID printing until now. So now the Fed is providing repos again, not that much. And I just read an article on Bloomberg that there was an emergency meeting or a sideline meeting between John Williams, head of the New York Fed, and a whole bunch of representatives from different banks as to why they weren't utilizing the repo facility more. That because what they're doing is their banks are borrowing at higher rates from other banks than the Fed is offering on repo. And then John Williams is like, why are you doing that? Why are you paying more when you could just come to me and I'll give you the cash? And they're like, basically, well, it looks bad if we do that, and we don't want to come to daddy, for money, because then it makes us look really weak, and then other banks charge us higher interest rates because they don't trust us. So the only way they can make the repo facility more attractive is by forcing everyone to use it, so everyone is on an equal playing field. I think they'll probably try to do that. But anyway, the fact that there are repos going on now, even if they're small, means that they're out of cash. There's no more cash. So something's going to buckle, whether it's somebody leveraged in the Bitcoin market, somebody leveraged in NVIDIA. Since the cash isn't flowing anymore, something is going to cause a margin call somewhere else, and everything's going to start falling over very fast. Remember, Silicon Valley Bank was fine one day, and the next day it was gone. So the same thing's going to happen this time. It's going to be some other catalyst, some other bank, some other institution, but it's going to happen pretty soon.
The fact that it seems like the mainstream is actually starting to pay attention now.
Well, yeah, the mainstream will follow whatever's hot. If Bitcoin's hot, they'll follow Bitcoin. If gold's hot, they'll follow gold. So there's no hedge there. There's nothing new there. To me, what's happening now is that gold, it's not that gold is consolidating, it's that the dollar is taking a rest, because now we're at a breaking point where, we're at either a deflationary moment or a further inflationary moment. We have to pick the course. So as long as the Fed hasn't picked yet, because it's barely hanging on with the short-term interest rates, and it's barely hanging on with this, and it's trying to give repos to try to stabilize everything. So as long as we're at the fork and we haven't taken a path, things are going to be volatile up and down. Gold has gone up $100 one day, down $100 the next day. Is it up today or is it down today? I don't even remember. But I think it's steady today, and gold stocks are diving because other stocks are diving because Nvidia was a buy the rumor, sell the fact thing, and Bitcoin's diving, and that's probably causing margin calls in other places because people take out debt to buy Bitcoin. Who knows how much debt is stacked into Bitcoin? Nobody knows. So I think we're going to continue to be volatile until the Fed picks a direction. And I know which direction they're going to pick. So it's just a question of waiting it out. And as for the dollar price, I'm not even going to say what it doesn't even matter. The question isn't what the dollar price of gold is going to be. The question is at what dollar price doesn't even, where are we going to be when nobody with dollars will give any will be able to buy any gold because nobody with gold will want any dollars. So what's that dollar number where everybody with gold just says stop? I'm not taking any dollars. I'm just gonna because I'm just gonna use this stuff directly, and then gold becomes money again directly. What number is that? I mean, I would guess maybe somewhere around 80,000, 60,000, 80,000. I mean, it depends how much money the Fed prints. If the Fed stops printing, it'll stop at 100% now, which is about 30,000. But I know they're going to print more, so it could stop at 60,000. And then, it doesn't even make a difference because the purchasing power is the same anyway, no matter what dollar number we end up at the end. The value of the dollar goes down so fast that all of my bills keep going up nominally so quickly that nobody cares about paying them anymore, and then everything just stops. Well, then I just stop paying my debts, and then the company stops providing its service, and then everything just stops, and then you have to use something else. So what are people going to use? Either nothing or money. So it's going to, in the immediate aftermath, it's going to have to be gold and silver coins. Like, there's going to have to be, in the very immediate aftermath of whatever this is going to be, there's going to have to be collector people that are knocking on my door and saying, give me the silver coins or we'll shut off your electricity. And initially, it's only going to be the people that have silver coins that will even have the ability to have electricity because no one else will be able to pay anything. So that shouldn't last too long because it shouldn't take too long for gold and silver to start circulating, right? In order for these coins are like the electrons in the power plant in the system that's moving negative charges where the electricity is going through the wires. If you have no liquidity moving through the system, everything stops until you find something that's liquid enough to move through the system. Derivatives don't work, so then you use the money itself, and I think that'll be like a few months until we get something going again. And then we can start this whole game over.
Every monetary collapse begins quietly, in the plumbing of the system, long before the public sees a headline or a chart or a crisis countdown clock. And because most people don't watch the plumbing, they watch the stock market or Bitcoin or whatever meme asset is trending. They never see the pressure building in the pipes. They only hear the explosion. If you really want to understand where we are, you have to start in the largest, deepest, most systemically important money market in the world, the secured overnight financing rate, the SOFR market. This is the interest rate at which banks lend cash to each other overnight against treasury collateral. Think of it as the heartbeat of all global dollar liquidity. When SOFR rises, it usually means banks trust each other less, demand more collateral, and are increasingly unwilling to part with dollars, even for a few hours. And lately, SOFR has been creeping higher and higher, occasionally even exceeding the Federal Reserve's own upper limit on the Fed funds rate. That is a red flag. The Fed funds market, by contrast, is irrelevant. It's tiny, 1/100th the size of SOFR. It is like watching the kiddie pool when the ocean is behind it. Yet mainstream economists still obsess over the Fed funds rate, as if it actually dictates global dollar flows. It does not. SOFR does. And SOFR is telling us that something is breaking. Daily volume has surged to $3.2 trillion, not because of healthy market activity, but because more and more institutions desperately need cash overnight to keep massive derivatives structures from toppling. These are not small operations. These are the largest hedge funds, banks, and institutional players in the world, many operating on razor-thin margins using massive leverage. If they cannot roll funding overnight, they blow up. It is that simple. The problem is that the system is running out of real dollars, not nominal dollars. There are plenty of those in cyberspace, but usable, scarce dollars in the banking system. We are approaching the same conditions that led to the repo crisis in September 2019. Back then, the Fed tried to shrink its balance sheet modestly. But the moment reserves dipped below a certain threshold, overnight markets seized up. SOFR exploded to 10% in a matter of hours. Banks simply refused to lend, even against treasuries, because the most basic form of interbank trust, liquidity itself, evaporated. Instead of letting the system purge leverage, the Fed panicked. It reopened repo operations, bailed out the market, and 3 months later, coincidentally, had the perfect excuse to print $4 to $5 trillion after COVID hit. Whether that sequence was spontaneous or opportunistic is up to interpretation, but the underlying reality is the same. The system needed to print, so it printed. Fast forward to today. Banks are already approaching that same reserve threshold. The Fed has restarted repo operations, quietly, carefully, hoping nobody notices. And an article from Bloomberg just revealed an extraordinary detail. New York Fed President John Williams held emergency meetings with banking representatives, urging them to use the Fed's repo window because banks were borrowing at higher rates from each other rather than from the Fed. Why? Because going to the Fed looks weak. It signals distress. And in the interbank world, appearing weak means everyone will charge you more or refuse to lend to you entirely. So banks would rather hemorrhage money borrowing at inflated rates than tap the Fed. That is how fragile confidence has become. There are only two possible ways this ends. Either the Fed forces all banks to use the repo window, essentially socializing the entire overnight market, or the plumbing cracks. Something snaps, and we see another SVB-style collapse happen overnight. And that collapse will not be small. When something breaks this time, it will not be a mid-sized regional bank that goes down. It will be something leveraged to the global derivatives machine. Something too big to fail. Something that forces the Fed back into full-scale QE in a matter of hours. What happens then? The same thing that always happens. The dollar falls, gold rises, and eventually something becomes unanchored.
I don't think that central bank accumulation of gold is relevant. I'm not saying it has no effect. It affects the gold price because it's another buyer, but I don't think that central banks will be able to save any of their currencies by accumulating gold. And the example I just keep going back to is Turkey. Turkey has been the biggest buyer of gold. So the Turkish central bank they're up and down, but like lately, I think over the past 2 quarters, they've accumulated a lot of gold. If you look at their gold reserves, but their currency is still on a hyperinflationary path. The value of it keeps going down and down and down. At the point where you see this in countries that have already reached hyperinflation. I think we talked about this before, that why does hyperinflation take so long? It's because, like, imagine you're in a car and you have the gas floored and the brake floored at the same time. Right? So if we're in a dollar system, then the dollar, it's the fact that you can still use dollars and the central bank can peg at an artificial price to the dollar and cause shortages in its country by doing that. So people will end up in bread lines. So you can put a brake on your currency by using dollars instead, and then what you see is like a diagonal in the value of the currency as it wants to go up, it wants to go down versus the dollar, but the central bank keep pushing it down, like artificially, and causing shortages. So that's where Turkey is. If you look at the currency, the Turkish lira, right? It's on a diagonal. It keeps going up, meaning going down, against the dollar every day on the same curve. It's been doing this for like 4 or 5 years. And you'll see the same thing in Argentina, except when Milei was elected, like it devalued a little, suddenly, and then went back on that same diagonal, but the same break. So what my point is, at the end of all this, is that central banks can accumulate as much gold as they want. Nobody trusts them anymore. So if you're not going to openly say, I have this much gold, central bank X says I have 1,000 tons of gold. Now everyone with my liability units can get this much gold if they want. Here's the window. Come at 5 o'clock and we'll give you gold for whatever currency units you have. No central bank is going to do that. The only reason they buy gold is to sell it to save their currencies, and so it won't save any of their currencies. So whatever they're doing with gold doesn't matter. It's not going to save anything. There's not going to be a currency system. Currency is a derivative. There will be a currency system again. right? I don't know exactly how it's going to form, but in the immediate aftermath, you're not going to have currency. You're going to have money. Like, if we just take this down of several levels, right? If you have a credit card and you don't pay your bill, then the credit card stops giving you money and you can't use your credit card anymore. You can only live within your means. You cannot borrow anymore. It will not let you. Your credit card will not work. Even if it has a whole bunch of dollars on it, if the dollars, which are credit, are worthless, then it doesn't matter. So initially there won't be currency and it won't be barter. I mean, there's no qualitative difference between barter and money. The only difference is that money is a more liquid commodity. Barter is trading one good for another good. Well, so is money, because gold is a good and or silver is a good and you're trading it for other goods. That's barter. I mean, one's barter, the other's barter. The only difference is that one is a more liquid commodity. You can use it and you can divide it and you can trade it, around to different people.
When a fiat currency enters its terminal phase, people always imagine an orderly transition. They imagine the Fed hosting a press conference, announcing some kind of new dollar, maybe with a patriotic name, a new color, or a blockchain wrapper. They imagine politicians calmly explaining the situation, the public cooperating, and the world slowly adjusting, like passengers on a flight during turbulence. That has never happened in monetary history, not once. Monetary resets are never calm. They are sudden, disorienting, and only obvious in hindsight. Look at Weimar Germany, which people love to reference but rarely understand. The hyperinflation did not begin suddenly. For years, the mark lost value gradually. Then the decline accelerated. Then, during the final phase, gold plotted a curve that resembles the curve we are beginning to see today. A powerful upward arc that reflects not enthusiasm, but the exhaustion of the currency. People think gold went parabolic because people wanted gold. No, gold went parabolic because nobody wanted marks, and nobody would accept them except at rapidly worsening exchange rates. Gold wasn't rising. The mark was dying. Look at the Turkish lira today. Turkey's central bank has accumulated enormous gold reserves, one of the largest accumulators on the planet, and yet the lira still hyperinflates. Why? Because holding gold is not the same as allowing your citizens to redeem their currency for gold. And no central bank will ever do that voluntarily unless forced. Gold is emergency collateral, the last resort, the final form of confidence. But once confidence is gone, it is too late. Gold cannot save a currency after trust has died. The dollar is not yet there, but it is following the same curve, earlier on the timeline, but unmistakably similar. The driver is not a single event. It is the structural problem. Debt that cannot be paid, interest rates that cannot rise without destroying the issuer of the debt, and monetary authorities who can only choose between printing or collapse. Printing always wins. Now let's return to the plumbing. The SOFR market, the repo market, the banks refusing to appear weak. When the Fed begins offering emergency liquidity in small amounts, it is like firefighters tapping the hydrant to see if the water pressure is still there. The system is functioning, but barely. The moment will come when banks collectively have no choice but to flood the repo window. And that moment will be interpreted by the public as stability. The headlines will read, Fed provides liquidity to ensure smooth market functioning. The markets might even rally that morning, but beneath the surface, that will mark the beginning of the end. Because when the Fed becomes the only lender, it becomes the only market. Price discovery disappears. The treasury market, worth tens of trillions, stops behaving like a market and begins behaving like a managed system. This is not speculation. It has happened before. The Bank of England was forced into yield control in 2022 when the UK's pension system nearly collapsed. The Bank of Japan is already in permanent yield control. The Fed will be next. Once the Fed commits to yield control, it must print unlimited dollars to maintain it. Unlimited dollars mean unlimited dilution, and unlimited dilution means a currency without a floor. That is when the gold curve snaps upward. Mainstream analysts will try to explain it. They will write articles about short squeezes, or safe haven demand, or geopolitical uncertainty. They will not acknowledge the real cause, the collapse of the dollar's credibility. They cannot acknowledge it, because acknowledging it would also acknowledge the collapse of their own models, their own education, and their own careers. This is the point where gold stops behaving like an asset and begins behaving like money. The distinction is subtle but important. When gold behaves like an asset, it fluctuates in dollar terms, influenced by sentiment, ETFs, futures options, monetary policy. When gold behaves like money, its price moves for only one reason. The currency used to price it is dying. And this is exactly why asking, where will gold top in dollars, is the wrong question. The correct question is, at what point will gold holders refuse to accept dollars at all? That is the real top. A nominal price of $60,000, $80,000, $120,000? It doesn't matter. The point is the purchasing power of the dollar at that moment. If the Fed stops printing today, maybe the final exchange rate is $30,000. But the Fed will not stop printing. The plumbing will not let it. The banking system will not let it. The political system will not let it. The debt will not let it. So the real final dollar price of gold is not a number. It is the moment the dollar is rejected. And silver? Silver is not just a monetary metal. It is industrial, monetary, and the smallest major market on Earth. The moment capital flees diluted currency and seeks real assets, silver will not merely rise, it will gap. People forget that silver can double in months, triple in quarters, and move violently because the market is so small compared to global capital flows. Silver is not a gentle asset, it is a beast. And when monetary systems reset, silver becomes the medium of exchange for daily transactions long before gold does. So what does the transition look like? Not in theory, practically. Imagine a small town. Currency has lost too much value too quickly. Grocery stores still exist, but their suppliers no longer accept dollars at stable prices. Deliveries slow. Truckers begin demanding cash equivalents, gold grams, silver coins, even commodity vouchers. Electric companies raise rates weekly because their own costs are becoming unstable. Someone knocks on your door and says, "We accept silver coins for your next bill. Do you have any?" The people who do get to keep their lights on. The people who don't begin searching for them. That is not science fiction. That is simple liquidity reprioritization. Meanwhile, banks shut down credit lines. Credit card limits collapse to zero because banks cannot afford the risk of lending something that is rapidly losing value. People with high incomes suddenly find that they cannot buy groceries because their digital credit has stopped clearing. And when credit dies, barter emerges. Not goat for wheat barter, but money for goods barter, using gold and silver as the medium. That is the real definition of money, the most liquid commodity. This immediate chaos does not last forever. Human beings adapt quickly. Within months, small local credit systems emerge, based on gold and silver reserves, not fiat. People begin issuing physical IOUs again, backed by real collateral. Local banks reappear, not as digital institutions, but as warehouses of real money. This is how the monetary system rebooted after Weimar. This is how it rebooted after every collapse. Always the same pattern. What about Bitcoin? People always ask. Bitcoin will survive. It will remain valuable, perhaps even more valuable in real terms. But Bitcoin will not function as the first medium of exchange during the reset. You cannot use a digital asset for trade when electricity supply is unstable, internet outages occur, banks are insolvent, and merchant infrastructure collapses. Bitcoin will be used later, after stability returns. But the reboot starts with metal. Always metal. This is why understanding now, before the reset, is critical. Not because you should panic, but because you should prepare mentally. Preparation is not about stacking endless amounts of gold. It is about understanding the structure of what is coming so that, when the headlines arrive, you are not confused.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.